With 2 weeks until enrollment ends, we're focusing on Obamacare. This is your Market Checkup. Hi fools, welcome to Market Checkup. I'm here with Michael Douglas, the newest addition to the healthcare team. Welcome, Michael.
Thank you.
And it's great to have you on video. Hopefully we'll be seeing a lot more of you. But as I teased in the intro, 2 weeks until enrollment ends. We're really coming down to the deadline here for the Affordable Care Act. But you know, the biggest news this week wasn't actually the upcoming 2-week delay. It was President Obama's appearance on the joke show Between Two Ferns with Zach Galifianakis.
Yes, it was. And there were some pretty good lines in there. It also got a little vicious, a little awkward from time to time. I personally loved where Zach was asking President Obama what he thought about having a third term, and he said, well, you know, it's kind of like having a third Hangover movie. Not a great idea.
I like the part, and it's, you know, we're non-political here, but I think it's funny for anyone regardless of political persuasion. But I thought the part that was funny was when the president was describing the healthcare law, he goes, Zach Galifianakis goes, oh yeah, I heard about that. That's the thing that doesn't work. And why would you get the guy who built the Zune to design your website? But the truth is, as a promotional stunt, it did work, right? Traffic to healthcare.gov increased 40% after the Funny or Die video aired, and Funny or Die, the website which it was on, was the #1 refer to healthcare.gov. So not only was it driving traffic, it was driving the type of traffic that people are concerned that the Affordable Care Act isn't getting, which is younger, healthier people. Those are the people who watch internet segments like this, and that's exactly where we are. And you know, the numbers came out. So we're at about 4.2 million enrollees so far.
Right, and it's a good thing that they are focusing on targeting some of those folks. Originally, HHS had said they were looking for about 40% or so enrollment from those younger age groups, and so far it's been in the kind of mid-20s, 27% for the most recent month.
And you know, we've seen a lot of estimates come down. I mean, originally the enrollment estimates were at 7 million, and then down to 6 million people. And at 4.2, yes, I think there's a good reason to expect a late surge here. We saw this in Massachusetts where people waited till the deadline, wait until the last minute to sign up. Young people also very notorious for this. So I think we will see a surge, but I think the ultimate enrollment data will probably end up at 5.5 million, but it may actually be a little more favorable than what we've already seen. Obviously, Aetna and some other companies are concerned about the mix of the patients customers are getting.
Right, well, and it's kind of very much a tale of two insurers between sort of Aetna and WellPoint, who I'd sort of view as the biggest in this area. You know, Aetna on the one hand says, we expect to lose money in 2014 on this book of business. But when you look at Aetna, it's really not that big of a book of business, right? I mean, we're talking 3% of revenue, 1% of EBITDA, 135,000 members who have paid a premium, 200,000 who've signed up. Really not that big in an insurer with something like 20 million members. And then you look at WellPoint.
Yeah, they're on the other side of the coin. They're not saying we don't expect to make money. They're saying we do expect to make money.
They are at 3 to 5% profit margin on these members. We've got about 500,000 signups, and they're really pushing this pretty hard. So it's very good news for WellPoint shareholders.
Well, they were the most exposed to the individual market before the Affordable Care Act, and unlike a lot of the insurers were basically dipping their toe in the pool and just taking a smaller approach. WellPoint was no, we're jumping right in. We're going to try to create the largest footprint. I think they believe there'll be some stickiness in those relationships. Once they get people signed up, they'll stay within the WellPoint system. I think there's some reason to believe that, and I think if you're a WellPoint investor, you should be happy with how things are going. They look to be the only insurer who's going to make money likely off these exchanges in the opening year. So I think things are going well for them, and I think it's definitely worth watching how these sort of different strategies play out too. Where companies are sort of pricing their plans and how they're trying to capture customers as well.
Right, exactly. Well, and it's interesting because you have also a few other plays in there. Molina, for example, it's primarily a Medicaid insurer, but they've basically been very upfront about the fact that they are in the exchanges because some of their people, currently Medicaid for a lot of places, where the expansion has happened, up to 138% of federal poverty level. They expect a few other people who get up to that to then go a little bit above that. So they want to be able to offer programs and policies that work with them when they're at, say, 140 or 150% of federal poverty level. And then if they churn back down, as it's called in Medicaid, then they also want to sort of maintain that sort of sticky relationship, as you mentioned, with them.
Which I think makes all the sense in the world. It also has better, continuing coverage and should have better outcomes for those patients as well.
Right.
All right, so let's move on to our next segment, which is 3 Obamacare terms investors, and really everyone needs to know before March 31st. So like the Affordable Care Act, there's a deadline to this segment as well. Hopefully people don't procrastinate watching it. But let's start with our first term, which is individual mandate.
Yeah, so the individual mandate basically says you have to buy insurance. And if you don't, it's going to be either $95 or 1% of your income, whichever is more, that first year. And then it's expected to scale up in the years after.
It's the stick to the carrot of potentially getting cheap, affordable insurance when you couldn't before. It's what really makes this system work. It gets the young, healthy people in the risk pool as well. It's also the part of the law that polls the worst. People generally, when you look at the polling, people are opposed to the Affordable Care Act, but they like generally the individual components of it, which makes it a lot like a lot of other government programs. But the part that they consistently don't like is the individual mandate, because people don't like paying taxes. They don't like being required to buy something they may or may not want. But it's there, it's critical, it's not going away, and if you don't get insurance, you are going to have to essentially pay this tax. Now, they have made some changes. HHS made some changes where you may be able to get around it for a couple of years, but eventually this is going to become the permanent, unavoidable law of the land.
Right. Well, and that's going to be a real benefit, I think, to some of our hospital operators. So when you look at uncompensated care, or what's also called provision for doubtful accounts, bad debt, somebody comes in, they can't pay, they don't have insurance, they're still treated. Tenet Healthcare, for example, wrote off about $1 billion to doubtful accounts last year. HCA, the largest hospital operator in the country, $3.9 billion last year. So that's real money, big money that hopefully, as more and more people get insurance or get Medicaid or something like that,
that bad debt expense will decrease. That's why you saw a lot of volatility with the hospital stocks going into the Supreme Court decision over the individual mandate, and largely why hospital stocks are expected to benefit from the Affordable Care Act in general.
Right. Well, and they've been very clear about both HCA and Tenet have said we expect to make money from the Affordable Care Act. They're both guiding for some benefit to EBITDA. We'll talk about that a little bit later.
And hopefully their investors make some money as well.
Yes.
All right, so let's move on to our next term, which is metal plan, because there are 4 types of plans out there. People might be a little confused.
Sure. So the metal plan, bronze, silver, gold, platinum, and they're based on actuarial value, which is basically the Affordable Care Act has identified these 10 areas of essential health benefits. Prescription drugs, lab services, hospitalization, emergency room, things like that. And this actuarial value basically says how much of those costs will this plan cover on average. So you look at a bronze plan, it's 60% actuarial value. Silver is 70, gold is 80, and platinum is 90.
And so, to put that in, easier terms, that although everyone should probably have understood that.
Right.
But if you spend $10,000 in medical costs, if you have a platinum plan, $9,000 of that will be covered by the plan provider, down to $6,000 if you have a bronze plan. So obviously your cost, if something goes wrong, is higher the lower your plan is. But on the other side of that, your monthly premium is a lot lower with a bronze plan. And we've seen a lot of popularity drift actually, not with the more inclusive platinum and gold plans, but actually the most popular plans are the bronze plans, which are the cheapest on a monthly basis, and the silver plans, which get a lot of the subsidies as well. But we've also, well, let's move on to our next term, and which is death spiral, and this is one that's been in the news a lot as well.
Right.
Obviously, it's great for headlines, but what does it mean?
So the death spiral is this idea that, all right, let's say that not enough of these young, healthy people sign up for insurance this go around. So the insurance companies are going to look at this and say, oh, well, because we've got sicker people who are using a lot more care, if we're going to make money, we need to go ahead and raise premiums. And the idea is that then next year, when open enrollment happens again, the least sick bunch of people in the exchanges will say, well, so we signed up for healthcare last year, but premiums are up 25% this year. This really isn't worth it. I'm going to go ahead and pay the penalty. And then the next year, that will continue. So it'll sort of have this cascading effect.
And you've seen Aetna's CEO talk about his concerns over how much premiums may have to go up from this year to next year.
Right. Personally, I don't really buy the death spiral hype for two reasons. The first is the reinsurance fund. So if insurance plans are losing 8%, then the government's going to step in and kick some cash to the insurers to help them out, to make sure that they don't lose too much.
This is the Obamacare bailout people have talked about, but it actually goes both ways, where if they're making too much money, if they have a better than anticipated group of customers, they actually have to pay some back into that.
Right. And the second piece is that, so if you look at the CBO, their stats released February 5th, they estimate that about 80% of the 24 to 25 million people that they expect to have exchange-based insurance by 2017, about 80% of them will be receiving a subsidy of some sort. So with that, those subsidies aren't based necessarily on the cost of your plan, so much as they are based on your income. So things like how many people you have in your family, your personal income, et cetera. So what that means is, if insurers have to raise prices, that's not going to affect these individual consumers in these subsidized health plans. It's going to affect the government and the amount that the government's going to pay in these subsidies, but it's not going to affect the people actually sort of at the point of contact. So I don't necessarily see them saying, oh, well, my plan didn't go up any, I'm going to not do it this year.
Yeah, so death spiral, more media hype than actual threat overhanging the country.
Right.
Okay, well, let's move on to our next segment, which is what stocks benefit most from the Medicaid expansion? This is an investing show. People want to know, how do I make money investing? So
sure.
In your opinion, Michael, what stocks are set to really poised to profit from Medicaid?
Well, first, a little bit about the Medicaid expansion. So we've seen 26 states and DC expand Medicaid up to 138% of federal poverty level. That means 24 haven't. I think a lot of where people will make the most money will depend on which states ultimately end up expanding Medicaid. So if you look at WellCare Group, for example, very much a Medicaid play. They've got 2.8 million members, 1.8 million of which are Medicaid. But their two biggest states, Florida and Georgia, both of which have not expanded Medicaid. Although Florida may, there's some talk about that going on.
Well, and I think that's potentially a chance for upside, because the states that don't expand, they're really throwing away free money. And the thought is eventually they will cave and expand Medicaid. So if you have a stock that should benefit but is actually playing in a lot of states that haven't expanded yet, there's potentially more upside there.
Right, exactly. And you look at a stock like Molina, they've had a lot of benefit, right? So they have 11 states. They operate in 11 states with Medicaid, 6 have expanded, and you've seen their revenue up 50% in the last 2 years. I mean, that is seriously good for an insurer.
Well, that's the impact of the law. I mean, they're literally getting fed new customers.
Right. If you're looking for something a little bit more diversified, I'd say perhaps WellPoint. They're definitely a Medicaid play insofar that they bought AmeriGroup for $4.5 billion in 2012 specifically to make a play on Medicaid managed care. That was like their really big push there. But they're also diversified in a lot of other areas. As we talked about, the individual insurance market, and a lot of other places. So they might be sort of a safer Medicaid play.
It's almost like a broader Affordable Care Act play in that sense, where you have the Medicaid expansion and the large exchange footprint as well.
Right.
All right. Also, we talked earlier too. The hospital stocks are a big advantage of Medicaid, but we'll go over that again. I mean, you talked about the bad debt expense, nearly $4 billion for HCA, about $1 billion for Tenet. Medicaid gets expanded. They will likely be serving people who are now covered, even if they're not getting fully compensated. They're still getting some, so that should reduce. But I think the other benefit is it's been shown that people who have health care are more likely to use that health care. And so utilization's been a big concern across the industry. And we've seen some concern with insurers that, sick people are going to get health care and they're going to use a lot of it. It's going to drive up demand for services. Well, that's great for hospitals, right? So it might be bad for insurers, but if someone comes in and needs a lot of procedures at a hospital, they're happy to provide that, especially if they're going to get paid for providing it. So you take a look at these hospital stocks, and we've seen a lot of mergers in the industry as well.
Yeah, well, and Tenet and HCA have both been very clear about the fact that they expect to receive benefit from the Affordable Care Act. Community Health Systems really hasn't talked about it much, but frankly, with their recent purchase of HMA, they probably have kind of enough on their plate that they're not necessarily breaking it all out. But Tenet is saying that they expect about a 4 to 7% gain on EBITDA from 2013 based on the Affordable Care Act in 2014. HCA says something closer to 1 to 2%, but still, this is tangible benefit to these stocks.
Yep, and I think you and I might disagree what our favorite hospital stocks are, but I think that's definitely a place investors need to look to potentially take their money and take advantage of this paradigm shift. Obviously we're not the first people who brought it up, but I think the story and the actual impact of this growth is far from over. I don't think people have quite figured out exactly how impactful it could be to these stocks. So there is still some upside left.
Absolutely.
All right, so let's move from upside to potentially downside. And this is how Obamacare could harm biotech stocks. And I know a lot of people think, the Affordable Care Act is limited really to insurance and hospitals and maybe some healthcare IT, which we could get to a little later. But really, it touches everyone in the industry, whether it's an excise tax on medical device makers or pharmaceutical companies kicking in some money as well. But you pointed out, actually, I'm going to say it, but I'll give you credit for it. You were digging through Celgene, which is one of the big biotechs. It's a very popular company. It's gone on a huge run over the last couple of years. But they found in their 10K, they wrote, "We expect that rebates, discounts, taxes, and other costs resulting from the Affordable Care Act will have significant effect on our profitability in the future."
Yeah, and if you even look at the next sentence, it says, in addition, potential reductions to the per capita rate of growth in Medicare spending under the Affordable Care Act could also have that effect. I think this is a few things, right? As you mentioned, the rebates that pharmaceutical companies have been giving out on their drugs tied into the Affordable Care Act because of the expectation of greater volume. I think as well the Medicare cuts that we're seeing kind of popping in with the Affordable Care Act is really a big potential issue. It particularly concerns me with a company like Gilead, right? Because you've got Sovaldi, hepatitis C pill, 90% cure rate, $84,000 for a full battery of treatment.
It's a revolutionary product. It can essentially cure hepatitis C in 12 weeks, but you will pay for it.
You will pay, and they're seeing a lot of pushback from payers. Recently, the California Technology Assessment Forum gave some pushback and said, this is really what we view as kind of a low-value drug. Not because it doesn't work, but because it's so expensive.
Well, and that's the thing. You wonder if they're going to put people on drugs with lesser cure rates, more in that sort of 60-70% range, even if they're required with interferon, which Gilead's drug Sovaldi isn't for genotypes 2 and 3. Soon won't be with FDA approval for genotype 1. You wonder if they're going to opt for drugs with lesser cure rates, and then for the people who don't get cured, then move them on to a more expensive drug like Sovaldi. I think the pushback is greater than Gilead investors originally looked. We've seen that stock be under pressure lately. It's certainly more than I actually was expecting. And I think there's now actually more of a window of opportunity for a competitor like AbbVie, which has an equally effective product. It's got a 90% cure rate, but the dosing is a bit of I don't want to say it's a mess, but it's a lot more complicated than Gilead's drug. It's 6 pills a day versus Gilead's, which is just 1. And so the concern is, why would a doctor prescribe, a 6 pill a day regimen that a patient could screw up versus a 1 pill a day regimen that they're likelier to follow? Obviously, you want the people with hepatitis C to follow the treatment regimen as closely as possible. But if AbbVie prices it aggressively, they actually may get a lot more love from the payers, and they may be pushed by payers to be prescribed over Sovaldi, and it actually may give them more market share and more upside than investors were expecting.
Right. Well, and it does make me wonder a little bit about whether there's going to be more pricing pressure on orphan drugs too.
Yeah.
I think we could see some movement there just because they are so expensive.
Up to $500,000 a year.
Right.
And it's you take a look at the patient populations, and that's why we haven't seen that much, right? Because an insurer may only have a few hundred people who they have to cover for this drug. So at the end of the day, it doesn't impact their bottom line that much. But as a principle, they may start pushing back. I think some really expensive cancer drugs too, if there isn't a huge movement as far as how far it extends overall survival, there could be some pushback on that as well. That's really a longer trend I'm watching in the industry, but in some ways Sovaldi has been a bit of a test case here, so it'll be interesting to see what happens.
For sure.
All right, now let's move on to our wild card round, where we each have a story that we wanted to highlight for this week. As your host, I will do the honor and go first. And the story that caught my eye, Michael, was actually one out of Maine that was talking about these insurance co-ops. Now, WellPoint is the big player in Maine. They run the Blue Cross Blue Shield plan there. But a small co-op called Maine Community Health Options has just absolutely cleaned up. It has 80% of the enrollees on the Maine market. I mean, this isn't just going toe to toe with Goliath. This is a blowout akin to the most recent Super Bowl.
Right.
I mean, it's not even close. And Maine Community Health Options is, as I said, it's an insurance co-op. This is a nonprofit organization that is funded by loans from the Affordable Care Act, which had $2.1 billion in loans to help support the growth of these organizations. There's 23 of them around the country, and they've done pretty well enrolling. The one in Maine is doing the best as far as competition goes, but they've enrolled a little less than a tenth of overall enrollees so far. So, it's a pretty strong showing for a group of organizations that I think there was some skepticism about their viability at all. So it's definitely something interesting to watch. They haven't all been as successful as I said, but if this proves out, if they can keep their customers happy, if they can keep growing, if they provide good service, and they do little cute things like give gift cards if you get a physical, and just things that make their customers feel welcome to be in the system. If they're successful with this model, it could potentially disrupt the traditional insurers. So, there's no way to invest in a nonprofit co-op, but you need to maybe take this as a potential long-term risk to an insurance stock if you own it. But I think what would be more likely is that the insurance stocks would just adopt the tactics that didn't really impact their bottom line, that would try to win customers over. But I think it's going to be interesting to see how healthcare changes because of the Affordable Care Act. Sure.
No, I definitely agree. And I'm actually wanting to emphasize another part of where healthcare is really kind of changing because of the Affordable Care Act. One thing that the ACA has really focused in on are what are called ACOs, Accountable Care Organizations. These are with Medicare, although there are also private ACO plans that are popping up kind of around the country. But the idea is that Medicare says, okay, here's 5,000 people. We want to get we're going to incentivize a bunch of different physician groups, hospitals, whoever, to get together and provide coordinated care to these people. And if you are able to spend less than we would have had to, on average, to insure those 5,000 people, then we're going to give you a cut of the savings. And it's definitely part of this overall trend away from fee-for-service, which is, you pay X amount for a surgery and Y amount for an X-ray, and really toward population health management, which is this idea, okay, so how much did that surgery and that X-ray actually benefit the patient? Did they have to come back into the hospital because you didn't give them, a basic exam or something like that? Recently, CMS released data on the ACO success at the end of January. So 29, or about a quarter of the ACOs that have been around for a year, succeeded in saving enough money to earn a bonus from CMS. Doesn't really sound like that good of a number, to be honest. But to my mind, if you are basically able to get this group, this pretty disparate group of hospitals and providers and doctors all together, and get them to sort of work and play nice together, and then enough to go ahead and save money and earn a bonus, that is fantastic news 1 year in. This is a new way of doing things. We'll see a lot more happening here, I think. Anecdotally, there's been a lot of smart work these ACOs have been doing with trying to manage and prevent conditions like uncontrolled diabetes, congestive heart failure, that I think will really help save a lot of money for Medicare long term, and also help these ACOs make some money. One of the other things that tells me that there is good news here, and perhaps an opportunity, is that you see a lot of very profit-driven companies getting involved in ACOs. So Tenet Healthcare purchased Vanguard Health Systems in, I think, 2013, specifically to play in the ACO market, because Vanguard Health Systems was kind of the for-profit operator that was really most into ACOs. Aetna CEO Mark Bertolini has committed to 45% of Aetna's costs in 2017 will flow through some form of value-based network. Maybe not an ACO, but something along those lines. And we're seeing United Health's Optum unit is really starting to kind of push this whole, we can help an ACO with actuarial expertise and consulting. So there's some real opportunity there.
Yeah, and I think that's a larger opportunity and a larger trend in general when you see a lot of these, sort of what does the Affordable Care Act look like in 25 years? What does American healthcare look like? ACOs are generally one of the top predictions, as this is actually the way care is going. And I think there's a lot of room for a lot of different players in there. You mentioned the traditional insurers. I don't think they're necessarily going to be nudged out. Someone like Aetna CEO Mark Bertolini is certainly very aggressive, and he says what he thinks, and if they're moving that way, that's what he believes to be the future. But I think you look at the pharmacy benefit managers like Express Scripts and Caremark. They compete with Optum. There could potentially be a bit of a land grab to get in there, so they can work on some of that actuarial stuff. And also, I think you look at healthcare IT companies like McKesson have to be part of the process for all they provide. Potentially something like Athena Health as well. So it's really going to be an all hands on deck approach to helping bend that cost curve down.
Right. Well, and especially looking at the sort of the EHR side, right?
Electronic health records.
Right. With Athena, I think there is some real opportunity because these ACOs may be in different buildings, right? But this is an easy way to go ahead and share that data quickly in real time between, let's say, a primary care physician who's quarterbacking the entire work or something like that.
Yeah, I think that's exactly right on. Well, thank you, Michael. Thank you for joining Market Checkup. I hope everyone enjoyed Michael's debut. Hopefully we'll be seeing a lot more of them. Stay tuned to Fool.com for all your healthcare news, and Fool on.